Section 2 is on life insurance policy features. Now that we have discussed the different various styles of life insurance policies, now we will talk about the features, the clauses that can be involved in being in those policies. So insurance contract features and policy clauses that can be found in those various styles of life insurance. The first one is consideration clause. This is an exchange of values. Consideration means money has to change hands. Value exchanged or value sought. You seek life insurance on your life, therefore you're willing to pay a premium cost or that value you are seeking. So, consideration clause is exchange of values. It is technically, the technical definition of consideration is the application plus payment of the first full initial premium. So application information plus the premium, those two things together make consideration. So application information and premium in exchange for the insurance companies promise to pay. The insurance companies promise to pay will be stated in the insuring clause of any life insurance contract. Now, the payment of the premium. The payment of the premium has to be done by the policy owner. The policy owner is the person in contractual agreement with the insurance company. So they have to pay the premium on time or before the end of the grace period, so as the insurance company meets their financial contractual obligation of paying out the death benefit upon the insured's death to the named beneficiary. So payment of premium is an owner's right, and it is the owner's promise to pay. And it is what the owner must do by the due date or before the end of the grace period to keep the insurance contract in place, to keep the death benefit in place and keep that insured's life insured. Now, insuring clause. Insuring clause is the company's promise to pay. It is a clause stated in the life insurance contract itself, usually very early in the contract, usually appears on the first page or face page of the contract, and provides a summary of that contract. Remember that the insuring clause is always the insurance company's promise to pay something, promise to pay the death benefit to the named parties, named as beneficiaries upon the insured's death. So it provides an outline and a scope of coverage, and it also is referred to as the insuring agreement. It provides the death benefit, also the modal of premium payment, how often that person wants to pay that premium, whether monthly, quarterly, semi-annual, or annual. Usually will include beneficiaries named, and also any exclusions in the contract that the contract says we will not pay a death benefit out due to any of these reasons. So it also includes exclusion section of the contract. Now, incontestable clause, here the insurance company may challenge material misrepresentations made on an application. Those are false statements made on an application that are material to the underwriting of the contract. So those are known as material misrepresentations. So in an incontestable clause, the insurance company may challenge material misrepresentations on an application, but only during the first 2 years of the policy from policy issuance. So from the date the contract gets issued, the insurance company has 2 years from that date to prove fraud happened on that application of life insurance. And if they can prove fraud happened on that application for life insurance, then they can void out the contract. The most simplest thing they will do is pay back any premium they have taken in, but they will not pay a death benefit. So, any material misrepresentation found out by an insurance company within 2 years from the issue date of that life insurance contract is grounds for that insurance company to void out that life insurance contract. But they can only do it within the first 2 years of the contract from the issue date. Then they are eligible to rescind the policy and return any premium they have taken in. This incontestable clause protects the insurance company. Now, exclusions. Every policy will have an exclusion section listed in it. Many times it's in the back of the contract as part of all the legal terminology and legal statements being made by the insurance company. But every contract of life insurance will have an exclusion section. That's why it's important for you as a selling agent to always recommend the person sit down within a relatively short period of time from delivery of the policy and read the policy from cover to cover, including the exclusion section of the policy to make sure they understand any exclusions that this policy will not cover. Exclusions, most common, are death due to acts of war. Now, there's two type of war exclusions features that can be listed in the contract. A status war clause provides coverage. Coverage is not provided if the member of the military dies, regardless of whatever their cause of death is. This is a more restrictive definition. So, for instance, if the person were in military active duty, went out on furlough, got killed in a car accident, not due to, being in as part of military maneuvers, but was out on furlough and got killed in a car accident, and their policy had a status war clause in it, then it will not cover. It's the more restrictive of the two clauses, and it will not cover just simply because that person is in military active duty. Doesn't matter what the cause of death is, it will not cover. That's the more restrictive of the two. The less restrictive of the two is what we call the results war clause. And here, coverage is not provided if death is the direct result of battle or maneuver. But if the person were out on furlough this time and got killed in the car accident, and their life insurance policy had a results war clause in it, then it would cover the death of that individual. So it is a more lenient war clause used in some life insurance policies. Okay, so it would cover the cause of death as long as it is not related to their military maneuvers. Also, other exclusions that can be listed in a policy where an insurance company will not cover is death due to aviation, other than a regularly scheduled commercial aircraft. The big commercial jets don't go down as often as the small aircraft do. So many times your life insurance policies will not cover death due to aviation of those small aircrafts. And they can exclude it right out and list it as an exclusion in the contract. Also, they could exclude out hazardous hobbies or avocations. Maybe a person bungee jumps on a regular basis. Maybe they parachute on a regular basis. Maybe they scuba dive on a regular basis to very low depths. Maybe they race motorcycles or three-wheelers on the weekend every weekend. Any of those hobbies that a person could find themselves involved in could be hazardous enough for the insurance company to say, we're not going to cover a cause of death due to that particular hobby that you become involved in every weekend or on a very regular basis. So hazardous hobbies and avocations can be excluded out as well. Any criminal acts will be excluded out. Robbing a bank and getting shot in the crossfires, being a drug dealer and having your apartment raided and it results in a crossfire and a person gets killed as a result of that. Those are all criminal acts. And a life insurance policy will not cover death due to criminal acts. Also, under the influence of alcohol or drugs, if a person dies due to an overdose, influence of alcohol or drug overdose, that they themselves, initiated the drug overdose, many policies will exclude out and not cover. Also, death due to suicide, they will not cover if they commit suicide in the first 2 years from taking out the contract. So suicide is definitely not covered in the first 2 years from the issue date of any life insurance policy. Suicide is generally covered after those 2 years, but they will, if they do cover it, they will pay out the death benefit. And if they choose not to, the most that will be received is a refund of premium only. Now, entire contract clause or entire contract provision, as we call it, means that the policy owner is entitled to the policy application and any riders, waivers, or endorsements which have been added to the contract for extra protection at an additional cost, which then constitute making up the entire contract. The entire contract provision is a mandatory provision found in every contract. The new business department of any insurance company is going to copy the application you, the selling agent, have submitted to the underwriter. Once the underwriter approves the risk and approves the application then moves on to the new business department, and the new business department will photocopy that application you, the selling agent, filled out and got all of the necessary signatures on, and now they will photocopy that original application and put a copy of it in the back of the contract before they bind up the life insurance policy. So the actual copy of the application becomes part of the physical life insurance contract upheld in a court of law. So it protects the policy owner / consumer. FREELA provision, it varies from state to state. Please make sure you know what your FREELA provisions are based on the state you are taking this test in, because it does vary from state to state. FREELA provision has to be explained by the selling agent to the policy owner. We are obligated by state statute to do this. We must explain the free look provision a person has, that's the right to examine the policy, for several days before making a decision whether or not they wish to continue the contract. So we must explain the free look provision, and it does vary by state. Upon delivery of the policy, it allows the policy owner the right to return the policy after reviewing it, after reading it from cover to cover, thinking about it and reviewing it. For any reason, they could return it within that free look period of time, within that specified time frame. And when that insurance company receives that policy back within the free look period of time, they will just simply void out the contract and mail them a check or a full refund of premium they have paid to the insurance company. So typically, this free look provision is 10 days minimum, and some states it's even longer than 10 days. So please make sure you know what your free look provision is or the state that you are studying for your state licensing exam. Typically, it's 10 days minimum after delivery, after receipt of that policy by the policy owner. So you, the selling agent, will deliver the policy always to the policy owner, never to anybody else, because the policy owner is the person in contractual agreement with the insurance company. So you always deliver the policy to the policy owner. You will never deliver the policy to the policy owner unless you, the agent, have received the first full initial premium, because there is no coverage until you have received the first full initial premium, not part of it, all of it. So once you receive the first full initial premium, then you can hand deliver that policy to that policy owner, and then you are obligated by state statute to explain the free look provision they have, to sit down, read it from cover to cover, and decide whether or not they want to keep it or not. If they wish to keep it, all they have to do is continue making the premium payment by the due date or by the end, certainly of the end of the grace period, and they will maintain coverage. If they choose that it is a policy they do not wish to keep, then they need to send it back to the insurance company so the insurance company has it in their hands within that 10-day or 14-day or whatever your free look period of time is, and they must have it in their hands. Then they will void it out. Doesn't matter what the reason is, and they will refund a full initial premium paid to them by that policy owner. If the person holds on to the policy beyond the free look provision, however, and then decides they don't want to keep it and sends it back to the insurance company will still void it out, but they will prorate the premium. They will keep premium dollars for any days of coverage that policy owner had. So the only way a person can get a full refund of premium is to return that policy within the free look period of time, the free look provision offered them through the policy. Now, it's typically 10 days minimum after date of delivery of the policy, and you will have them sign a delivery receipt that you will then forward back to your insurance company, stipulating the date you delivered that policy to them, and the free look period of time starts from that date. It may be referred to also as the right to examine. So if you get a test question asking you something about the right to examine, they're asking you about the free look provision. Typically, it's a 30-day free look for any what we call senior market policies sold to senior citizens. Anytime we sell a long-term care insurance policy or a Medigap policy to a senior citizen, those type of policies will have the longest free look of 30 days. We just know that a senior citizen, it takes them longer to read through the contract, to think about it, maybe pass it in front of other eyes of a person they trust, maybe their attorney, maybe a caregiver, maybe a family member, and they pass it in front of their eyes to get their input on whether or not it's a good policy that they should keep. So senior market policies such as long-term care and Medigap policies sold to senior citizens will always have the longest free look of 30 days. Misstatement of age or misstatement of sex or gender of an individual is always contestable by the insurance company, no matter when they find out about it. So the misstatement of age or sex, gender provision of any life insurance policy gives the right to the insurance company to adjust the death benefit to reflect the benefit the premium paid into the contract would have purchased had the correct age been listed on the application or the correct sex or gender of the individual been listed on the application at the time they were applying for the policy. Typically, it will not void out the contract. The insurance company will not void out the policy. What they will do is adjust the premium going into the contract if they find out the error while the insured is still alive. They can adjust the premium higher or lower depending on if the person were less in age than what was stated on the contract of insurance application or whether or not they were older than what was stated. Also, if they were male versus female or female versus male, and they find out that wrong box was checked off on the application, once they find out what the true gender of this individual is, they can adjust the premium going into the contract if they find out the error was made while the insured is yet still alive. If the insurance company finds out the error was made after the insured is deceased, after the insured has died, then the only thing the insurance company can do is adjust the death benefit on the policy, higher or lower, depending on if the person was younger than what was stated or older than what was stated actually on the application, or if they were really male versus female or female versus male. Because males pay a higher premium on the life insurance side of the industry, where females pay a lesser premium on the life insurance policy side of the industry, because life expectancy for a male is shorter than life expectancy for a female. So, with a shorter life expectancy, males will pay a higher premium on the life side, and females will pay a lesser premium. Over on the health side, more goes wrong with females sooner in life, roughly about age 50, so females pay a higher premium over on the health side than males do, and obviously vice versa. So on life insurance, when the insurance company determines that an error has been made in either age, higher or lower, or female versus male, or male versus female, gender, then they reserve the right to always make the necessary correction on either premium being paid into the contract if they find out the error was made while the insurer is still alive, or on the death benefit proceeds to be paid out of the contract if they find out the error was made after the insured is deceased. And they will adjust that death benefit higher or lower, depending on premiums paid into the contract, what it would have actually bought at the person's correct age or based on the person's correct gender. Okay? So, typically, it will not void out the policy, but the death benefit may be adjusted upward or downward, depending on if the age was understated, then that would provide a lower benefit. And if this age listed on the application were overstated, then that could provide a higher benefit off by the insurance company payout. Now, the conversion option allows the policy owner to convert from one type of policy to another within that same company, whether it's individual or whether it's group coverage. When a person converts from term to term, same face amount, there's usually no insurability requirement. If they are converting from term to whole life, same face amount or lesser amount, generally there, no insurability requirements are required either. But if a person ever converts from, let's say, term to whole life with a higher face amount than what they're presently insured for, then yes, they will have to provide medical insurability to that insurance company. They will have to prove that they are in good enough health for that insurance company to want to take on that additional risk. So term to whole life, when you're converting from term to whole life and you want to secure a higher face amount than what you're presently insured for with the term policy, yes, you will have to provide medical evidence of insurability. Reinstatement provision on a life insurance contract applies to a lapsed policy. This is when a person, the policy owner, has not paid the premium by the due date and certainly has not paid the premium within the grace period. So one day after the end of the grace period, if the premium is not received by the insurance company, the contract will lapse. Coverage, there will be no more of. Coverage will lapse. So a person who allows their policy to lapse may, in the very near future, decide, I want to reinstate that policy. My best bet is to go back to the insurance company I had my original contract with and see what I need to do, or the insurance company will require me to do, to reinstate that life insurance coverage. So the insurance company will be very specific in telling them what they must do, and they must satisfy those requirements. Many times a lapsed policy, the person will still have a reinstatement provision option within 3 to 7 years from the date of lapse. Generally, if a test question asks you anything about year 8 and beyond, that will not be permissible for that lapsed policy to be reinstated by any insurance company. They feel too much time has gone by, too much capital premium would be needed in addition to other things, they are not going to work with that policy owner to reinstate coverage after the 7th year. So, usually a person has to prove evidence of insurability at reinstating the contract, and for sure, back due premiums, all back due premiums must be paid. You must bring that back to premium right up and paid up until today's date. So, proof of insurability must be provided to the insurance company when reinstating a contract of insurance, and back due premiums must be paid, brought up up until today's date. Plus, they must pay any interest that the insurance company decides to charge them for any back due premium. That is left up to the discretion of the insurance company whether or not they're going to charge interest on back due premiums. But if they do decide to charge interest on back due premiums, that also will have to be paid by the policy owner before they will consider reinstating the coverage. After 45 days, coverage is automatic unless otherwise informed by the insurance company. And it does not apply to surrender policies. Once a person surrenders a policy, that policy is over with. Once a policy is surrendered, you have sent the policy back to the insurance company, they have voided it out, there is no reinstating a surrendered policy. If there is any cash value, that has already been paid out to the policy owner in the form of a check, so there is no reinstating a surrendered policy ever. Grace period. We are all entitled to a grace period on our life insurance policies. That grace period is that period of time we still have as the policy owner to get the premium payment in the hands of the insurance company. So grace period protects the policy owner from an unintentional lapse of the policy. It is 31 days after the premium due date that a person still has to get the insurance premium in the hands of the insurance company. And if they do that, then the coverage will continue. If they do not get the premium in the hands of the insurance company by the last day of the grace period, the very following day after the end of the grace period, coverage has lapsed. Then they have to go through the reinstatement process to get that policy reinstated if that's what they wish to do. So grace period protects the policy owner from an unintentional lapse of policy. It is 31 days after the premium due date. During that grace period, is the insured covered? Yes, they are. During the grace period, they are still covered, but not 1 day after the grace period unless the premium has been received by the insurance company. The premium owed is subtracted from the death benefit anytime a person dies during a grace period. The death benefit is reduced by the amount of premium still owed that insurance company for not paying that last and final premium during that grace period. So death benefit is always reduced by the amount of outstanding premiums still owed them, and the reduced death benefit will be the amount of money paid out and to the beneficiary federal income tax free upon the insured's death. Automatic premium loan. This is a provision to many life insurance policies, and this became a provision that a person could choose on their policies since the 80s. Automatic premium loan provision on a life insurance policy authorizes the insurance company to borrow from the cash value to pay unpaid premium after the grace period expires. This automatic premium loan provision must be selected at the time of application. It includes a box that must be checked off on the application. So you must have this discussion with your client and ask them, would you like the automatic premium loan provision added to your contract? If you would, I have to check off this box on the application. It can be added to your policy now at time of application. It cannot be added later. And if you would like it, it could be added now at time of application at no additional cost to you. So most people will say yes to selecting the automatic premium loan provision when they know there is no additional cost for having this feature on their contract. But it must be selected at time of application, and it requires the agent to check off a box on that application that that person wants the automatic premium loan provision to be standard to their contract. There must be available cash value inside the contract. This is not available on any sort of term insurance policies. Only cash value, permanent cash value life insurance policies. It is designed to prevent the unintentional lapse of a policy due to the person forgetting to pay their premium. It creates a loan against the policy. So here's how the automatic premium loan works. If the box is checked off on the application, then the automatic premium loan will be part of the contract. It will be a provision to the contract. Then if the person fails to make the premium payment by the due date, they go into the grace period. They still have the grace period to pay the premium. Nothing will happen. They still have the grace period to still pay the premium, and coverage is still in place. But at the end of the grace period, if they have the automatic premium loan provision on their contract and they have not paid the premium at that point, then the insurance company will go into the cash value, take out enough of the premium dollars that came due out of the cash value and pay the premium with that money. They will now treat it as a loan on the contract. If the person wants to pay the loan back right away, they probably won't even incur any interest. If they don't pay the loan back right away, then it will continue to accrue interest every day that loan is outstanding on the policy. And the interest must at least be paid every year or will continue to erode away at the cash value of the policy. So if the person wants to pay the loan back right away, they probably won't even incur interest. If they don't pay the loan back, then the loan continues to exist on the policy and the accrued interest on the loan will continue to accumulate. And if they never pay back the loan, then the accumulated interest keeps growing and keeps eroding away at the cash value on the policy. And if it ever supersedes the cash value of the policy, we'll throw the policy into forfeiture. So having this automatic premium loan provision on your contract is a wonderful provision to have on the contract, but it must be chosen by the policy owner at the time of application, and it will not cost them more when they add it to their policy. Now, premium mode. Person has an opportunity to select the way in which to pay their premium. They could be charged an annual premium and pay the annual premium right up front, 12 months in advance. If they pay an annual premium, that's the cheapest way to pay their premium because there is no adjustment for an administrative fee. So that's the cheapest way to pay your premium is annually, 12 months in advance. But many people don't want to pay their premium to their insurance every 12 months in advance. They choose a lesser time frame. Semi-annual is 6 months in advance, twice a year. Quarterly is 4 times a year, every 3 months. And monthly is 12 times a year, once a month. Obviously, the more often a person has to allocate your premium to your insurance policy at the home office of the insurance company, the greater the administrative charge they are going to charge you. So the annual way of paying your premium is the least expensive because there's no administrative charge. Monthly is the most expensive. It is more convenient. It's less payment each month. It's easier to budget, but it allows the insurance company to charge a service fee, administrative fee, 12 times per year. As you are asking them to allocate your premium 12 times per year, so they will charge you an administrative fee that will be commensurate to a monthly charge and a monthly payment of your premium. Assignment of any policy is the assignment of ownership over to another party. Now, that other party you want to assign ownership of your policy over to as a policy owner could be a blood relative, could be a neighbor, could be a friend, could be your business, could be a church or a synagogue, could be a nonprofit organization. So it could be a person, it could be an entity that you assign ownership over to. Now, assignment means a complete transfer of ownership rights over to another party. Everything else about the policy stays the same. The insured is still the insured. All we're changing here in a policy assignment is assigning ownership of the policy over to a different party. And that could be anybody we wish to. So transfer policy ownership rights to another party. Absolute assignment is absolute assignment going a one-way street away from you, the original policy owner, over to the new policy owner. Absolute assignment is a one-way street. It's complete transfer of all ownership rights over to that other party. The child obtains the policy from the parents at the age of majority, if it is known as a juvenile policy, and its ownership rights transfer over to the child upon their adulthood. Now, absolute assignment, though, is 100% a one-way street. Once you sign the absolute assignment paperwork, you're assigning ownership of this policy that you right now own over to someone else. Now, that paperwork has to be sent off to the insurance company, and the insurance company has to receive it and record it. They have to record the new owner as the new owner on the policy. Then they will send the premium notice now to the new owner. So the new owner now owns the policy on your life. They could choose to keep the policy, or they could choose to send it back and receive the full cash surrender value of it. If they choose to keep the policy, the first thing they should do is make themselves the beneficiary on it, because maybe while you owned it, you had a different beneficiary name. Now that you have assigned ownership over to them, their first step in keeping the policy would be to change the beneficiary over to themselves, because now they're going to get the premium notice. Now they're going to have to pay the premium into the contract. It's going to be their money going into the cash value, and they then have ownership rights of establishing who they want to become the beneficiary. Many times they will name themselves as the beneficiary because now they own a policy on your life. So the policy pays out when the insured dies. So who better to name as beneficiary than themselves if they're going to continue making the premium payment? Now, collateral assignment is only temporary assignment. This is only a temporary assignment. It's only a temporary assignment, a temporary transfer of some of the ownership rights, not all of them, to another party, usually a bank or some sort of a credit union or financial lending institution. Here, you're only temporarily assigning ownership rights over to the bank to secure a loan of their money, usually at a reduced interest rate. And once you pay the loan back plus interest, they will reassign ownership of that policy back to you, and you will go along lifeline owning this policy with your cash value in it, doing nothing but increasing. So it is called collateral assignment, temporary assignment, transfer of some, not all of the rights to another party. The whole life cash value is used then in the contract to secure a loan from a bank. But once you meet your financial obligation back to the bank of paying the loan back plus interest on the loan back to the bank, then they have no desire to own a policy on your life any longer, and they will reassign ownership back to you. So collateral assignment, remember, is only a temporary assignment. You will eventually get ownership rights of that policy back. Absolute assignment means it is absolutely going away from you to this other owner that you have assigned this policy over to, and they will retain ownership rights. The only way you will get a policy back when absolutely assigning it to another individual is if that other individual decides to reassign ownership rights back to you. As they are the bus driver on the policy, they're the one that owns it, they're the one that controls it, and it's only if they wish to reassign ownership rights back to you will you ever get them. Absolute assignment is usually a permanent, one-way street going away from the original policy owner, and ownership rights are never returned to that original policy owner. Now, beneficiaries. Beneficiary provisions. Beneficiaries, you can designate a primary beneficiary. You can designate a secondary beneficiary or series of them. And you also can name a tertiary beneficiary, third in line to receive if there are no primary and if there are no secondary beneficiaries yet still alive. If you name more than one beneficiary, your designations have to add up to 100% if you use percentage splits, and they have to add up to the number 1 if you use fractional shares. So primary beneficiaries are first in line to receive upon the insured's death. You can name one or you can name a series of primary beneficiaries. A primary beneficiary can be an individual or an organization first in line to receive benefits upon the insured's death. If 2 or more are listed, then it is equally divided. If you can also designate a 75-25, a 70-30, a 60-40 split. So you will use percentage splits to determine who gets what percentage, but your percentage splits must always add up to 100%. Contingent secondary beneficiaries are second in line to receive if there are no primary beneficiaries yet still alive when the insured dies. So secondary contingent beneficiaries can be individuals or organizations entitled to receive proceeds only if all primary beneficiaries have predeceased the insured. And if a person decides to name a tertiary beneficiary, that is third in line to receive. That could be a person, that also could be an entity, it also could be an organization, it could be a nonprofit, it could be a church, it could be a synagogue, it could be whoever that person wants to name as a tertiary beneficiary. Many times it is a business because that person might have had an interest in that nonprofit organization or that business all during their lifetime, and now all their beneficiaries have predeceased them. Now they'd like the beneficiary, the face amount of their policy to go to what they call their tertiary beneficiary, which many times is a business or an institution or a nonprofit. Change of beneficiary. This is an ownership right of the policy owner. When you name a beneficiary revocable, you can change it anytime you want, but you must always make the change of a beneficiary in writing. Beneficiary can change at any time by completing a change of beneficiary form. Must be done in writing, unless that beneficiary has been named irrevocable. Change occurs on the date the form is signed. So you must change your beneficiary in writing. It's a form that you fill out, you sign it, you date it, you send it back to the insurance company, and the insurance company then must record that change of beneficiary. The change of beneficiary that takes effect from the day you sign the form. Revocable beneficiaries you can change anytime you wish as a policy owner. So revocable beneficiary, the policy owner has the right to change the revocable beneficiary anytime they wish. They just must change it in writing. It requires a change of beneficiary form be filled out, completed, signed, and dated, and sent on to the insurance company so they can record that beneficiary change. Now, revocable beneficiaries means you can change it anytime you want. Put them on, take them off, put them on, take them off, any number of times throughout your lifetime you wish to do. But if you need a beneficiary irrevocable, that means you cannot change it just because you wish to. You need to secure the permission from the irrevocable beneficiary in writing to be taken off as the irrevocable beneficiary, or to make any changes to the policy whatsoever requires the written permission of the irrevocable beneficiary. So when you name a beneficiary as irrevocable, you are giving power and clout and control of that policy to that irrevocable beneficiary you name. You can make no changes to the policy whatsoever without the written permission of that irrevocable beneficiary. That means you cannot lax it, you cannot forfeit it, you cannot surrender it, you cannot borrow from it, you cannot make withdrawals from it, you cannot make any change to the policy whatsoever without the written beneficiary, irrevocable beneficiary's permission. So, naming an irrevocable beneficiary in your life insurance policy, you are giving that person power and clout and control on your policy. They're almost like a co-owner of the policy right along with you. Although you own it, although you paid the premium into it, they have as many rights in the policy as you do. So an irrevocable beneficiary is named. A beneficiary designation cannot be altered as an irrevocable beneficiary without the written permission from the irrevocable beneficiary. Many times this is used in collateral assignment of a policy to a financial institution. Sometimes in divorce situations, it could be ruled in a court of law by the judge, or sometimes it didn't even be a court order ordered by a judge. Now, common disasters, simultaneous death act. When the insured and primary beneficiary die at exactly the same time, and medical personnel arriving on the scene cannot determine who died last, law says insured died last. That means the beneficiary died first. If the policy owner had named a secondary beneficiary, then the proceeds would be paid to the secondary beneficiary. But if they did not name a secondary beneficiary at all, now the proceeds must pass through the insured's estate. So the Common Disaster Simultaneous Death Act says, when the insured and primary beneficiary die and it cannot be determined who died first, it is assumed that the primary beneficiary died first. That means the insured on the contract died last. If there's any other beneficiary named, it will go to that other beneficiary. But with no other beneficiary named, now the proceeds must pass through the insured's estate. Death benefit will be paid to a contingent beneficiary if one has been named, and that contingent beneficiary is yet still living. Then it would pass on to the contingent beneficiary. But if a person only names one party as a primary beneficiary, and the primary beneficiary dies at exactly the same time as the insured does, with no other beneficiary named, that it is deemed that the insured died first, that the beneficiary died first, and that the insured died last. So now with no other beneficiary named, the proceeds must be paid through the insured's estate. If any other beneficiary has been named, it will go to them. With no other beneficiary named, and they both die simultaneously, then the proceeds must route through the insured's estate, not the beneficiary's estate. Spendthrift trust provision protects the beneficiary from its creditors. Creditors cannot attach or lien against the benefits left with the insurance company. Lump sum benefits are not protected by the spendthrift trust provision. So the spendthrift trust provision says when the proceeds of a life insurance policy are paid out in a lump sum to a named beneficiary, they are no longer protected, and they are subject to the creditors of that named beneficiary. But if those proceeds are designated to be paid out to the beneficiary over a period of time, generally over a period of years, then the proceeds left on account with the insurance company will be protected from that beneficiary's creditors. In other words, the creditors of the named beneficiary cannot try and attach themselves to the proceeds still left on account with the insurance company. They are protected. They can attach themselves to proceeds paid out to the beneficiary, They can try and attach themselves to those monies to pay off any debts that person owes them, but they cannot attach themselves to any proceeds left on account with the insurance company. That's what the spendthrift trust provision of the policy allows. Now, beneficiaries of policy loans. Trust can be named as a beneficiary of a life insurance policy, often true when a child or minor is named as a beneficiary. Because if a person names a minor child as a beneficiary and they die, the insured dies, the proceeds are going to be held on account by the insurance company for that child until they reach age of majority, whatever age of majority is true in that state. So a better route to go would be for the policy owner to contact a family attorney, have the family attorney create a trust, and then name a trustee on the trust to and put the policy as ownership of the policy being the trust. Trust will then pay the premiums on the policy, and then the trust is also named as a beneficiary on the life insurance policy. So then if the insured dies, the death benefit is paid back to the trust. And then the trustee can use the money to educate that child, put them K through 12, maybe even post-secondary college education or technical school, and get that child off to a good start in life. But no insurance company will ever pay death benefit proceeds out to a minor child. It just will not be done. They will be held on by the insurance company until that child reaches a specified age of majority in that state. And that is generally 18 or 21 years of age. So if they establish the trust can manage the funds for the child until a specified age. The child lacks legal capacity to receive those funds when they are a minor. So a better route to go would be to establish a trust in that child's case. Policy loans. Ownership has the right. A policy owner has the right, and ownership rights of a policy are that the policy owner has the right to borrow via a lending situation, via a loan from their cash value. Now, on whole life, I mentioned that you have the ability to borrow out up to 100% of your cash value anytime you want. You just need to place a phone call and ask that that loan be processed. They will process the loan and send you a check the following day. The loan will start to accrue interest from that very first day the loan is processed. So, policy owner has the right to borrow from their cash value on whole life up to 100% of the cash value anytime they want the money. On universal life, they have the borrowing privilege, or they can only borrow out up to 75 to 80% of their policy account value on UL contracts because their cost of insurance is increasing each and every year. So, policy loan is the owner's right to borrow via loan from their cash value. Is it equal to the full amount of the cash surrender value? And it is not available during the first 2 to 3 years of any whole life insurance contract. You will be charged an interest rate for the borrowing privilege not to exceed 8%, and this also varies from state to state. What's usual and customary, an insurance company will charge you somewhere between 5% to 8% interest rate on a loan when they process your loan. But again, that does vary from state to state. The loan does not create a taxable event. It's a borrowing privilege. You will have to be willing to pay interest on the loan for that borrowing privilege, but it does not create a taxable event for the person in taking out the loan. If death occurs with the outstanding loan, then the loan amount plus any interest due on that loan will be subtracted from the death benefit upon the insured's death. So death benefit minus the loan, minus the interest due on the loan, that lesser amount will be paid out to the named beneficiaries of federal income tax-free. Interest due on the loan must be paid each and every year. Otherwise, it will continue to accrue from year to year. And when that accrued interest on the loan plus the loan itself supersedes the cash value of that policy, it will throw that policy into forfeiture. So the policy owner needs to at least pay interest that comes due on the loan each and every year to avoid it eroding away at that policy's cash value, and in an effort to keep it from ever throwing that policy into forfeiture. Interest comes due each year on the contract policy anniversary date. Now, policy provisions, dividend options is another provision of any life insurance policy. Dividend options, policy dividends are paid to policyholders of mutual insurance companies that issue participating policies. Mutual insurance companies are owned by the policy owners, and mutual insurance companies issue participating policies. Participating policies are policies that participate in a dividend payout if the dividend is declared by the insurance company. Dividends are never guaranteed. Dividends are never guaranteed by the insurance company. Dividends will only be declared by an insurance company who has a profit, a surplus, or the year. Then many times they will declare a dividend because they want to keep their policy owners happy, because their policy holders are the owners of that mutual insurance company. And their goal and objective is to create an environment where the policy holders of the company can purchase insurance at the lowest possible net cost. So your mutual insurance companies will issue participating policies, and if they have a surplus, if they've made money for the year, many times they will declare a dividend, although dividends are never, ever, ever guaranteed by the insurance company. They will only be declared if the insurance company wishes to, and they will only declare them if they wish to, based on a profit for the year. So dividends are paid to policyholders of mutual insurance participating companies. They're not guaranteed, and they are considered in the insurance world a return of an overpaid premium. Therefore, you have paid your premium with after-tax dollars. Now, a dividend is a return of part of those premium dollars you paid for with after-tax dollars. Therefore, the dividend, when received, is not taxable as income. Dividends are received income tax-free. Now, there's 6 different options, 6 different ways to receive dividends. And we use the 6-letter acronym CRAPPO, CRAPO. 6 different options that a person has to choose how they want their dividend paid out to them. The first option is to receive it in cash. That means the dividend would be allocated to the policy owner on the contract anniversary date. And if they have the dividend allocated to cash, the insurance company will create a check, cut the check, mail it to them the following day, and within about 5 to 7 business days, they will receive that dividend check at the address they have on file with the insurance company for this policy. So they receive the dividend. It's received tax-free. They also can allocate the dividend to be used to reduce future premiums. So if they allocate the dividend to reduce future premiums, they can instruct the insurance company to apply that dividend against future premium costs. That eliminates them having to pay large premium costs in the future. Their premium would be reduced by the amount of premium that the dividend is paying. Anything else they would be sent a premium notice, and they would have to obviously pay that premium by the due date. They also can have their dividend allocated to accumulated interest. That just simply means, insurance company, thank you that you allocated me the dividend, but hold on to it and let it accumulate some interest for me. So accumulated interest is another way you can allocate your dividend. Dividends are placed in a separate account. Insurance company pays interest on the dividend. Interest is growth, and growth is always taxable to you in the year in which you receive it. The dividend itself will be received tax-free because that's a return of part of the premium you have paid to the insurance company that is not necessary for the insurance company to keep. So now they're allocating a dividend, and the dividend is being received by you, federal income tax-free, because it's a return of premium dollars you have already paid tax on. Therefore, the dividend in the insurance world is received tax-free. But growth on the dividend is always considered growth. Interest on the dividend is considered growth, and growth is always considered taxable to the recipient in the year in which they receive it. Upon death, the dividend will be payable in addition to the death benefit, and upon surrender of the policy, it will also be payable in addition to the cash surrender value of the contract. Now, number 4, paid-up additions. You could allocate your dividend to have the insurance company purchase additional amounts of smaller amounts of face amount insurance on your life that's paid up. No additional premium cost is necessary because they take the dividend of a certain amount and buy a certain amount of insurance based on your age, based on male or female gender, and however much that dividend will buy, that's how much insurance that dividend purchases for that face amount, but it's paid up. No additional premium is due on that additional paid up piece of insurance. So they take the dividend and they buy smaller additional paid up whole life policies. The small amount of additional paid up protection is added on the anniversary date because that's when you will receive your dividend allocated to you on your contract anniversary date. So if you have it allocated to paid up additions, they will take the dividend and purchase with it smaller additional amounts of paid up insurance on your life that will not require premium payment. It will increase your overall death benefit. So when you die, not only will your original face amount be paid out to your beneficiary federal income tax free, but so will the face amount of any of your additions that your dividends have purchased over the years. Now, you can also allocate your dividend to pay up your policy sooner. You might say, well, I don't want to keep making this premium payment all the way out to age 100. I want to allocate my dividends so that the insurance company uses my dividend to pay up my policy sooner, so I won't have to keep making a premium payment all the way out to age 100, like a person would have to do on a straight whole life policy. So you can allocate your dividend for paid up addition or paid up additions, that's number 4. You also can allocate your dividend to a paid up option on your policy. So you're instructing here the insurance company to take your dividend and pay up your policy, put that as additional premium going into your policy to make it paid up earlier than what is expected. And the last one, O, is 1-year term option. It's a 1-year term option. Now, this is known as the 5th dividend option many times, but in this case, it's listed as the 6th because it is the newest dividend option available to a policy owner. So, in this case, you are instructing the insurance company to take the dividend because you know you have an outstanding loan on your policy that will diminish the death benefit by the amount of the loan plus interest if you die. So while you have that outstanding loan on your original policy, you know if you die with an outstanding loan, your beneficiary is going to get a reduced amount, something less than the death benefit based on the amount of the loan plus interest due on the loan. So for that period of time you have the outstanding loan on your policy, you might choose to exercise the 1-year term option, where you would instruct the insurance company to take the dividend allocated to you on your contract anniversary date and purchase with it 1 year's worth of term insurance that could never be equal to greater than the amount you borrowed out of your original contract. Because if it could buy more insurance than what you borrowed out over here, that would increase the risk to the shoulders of the insurance company, and then you would have to prove evidence of insurability. So they limit the amount that your dividend can buy to no more than an amount equal to the amount you borrowed out of your original contract. So if you explain to the insurance company you wish to exercise this 1-year term option, then they will take your dividend, buy 1 year's worth of term insurance, only 1 year worth of term insurance on your life that is equal, or the face amount is equal to the amount you borrowed out of your original contract. And it will be in place for 1 year. So if that person died during that year, not only would the reduced death benefit on the original policy be paid out to the beneficiary, but so would the death benefit on the term policy, making them be very close to receiving the full amount of the original face amount of the policy. It's just coming, some from the whole life policy and some from the term insurance that is on their life for that 12-month period of time. At the end of the 12 months, the 1-year term is over with. The dividend has been used to purchase the 1 year's worth of term insurance. Now the dividend is gone because it will be to pay the premium on the term policy, and now the term policy is gone as well because it only bought 1 year worth of term insurance on the person's life. So 1-year term option, you're instructing the insurance company to use the dividends to purchase additional term insurance on your life that can never be equal to greater than the amount of money you borrowed out of your original contract. It is definitely used when a person has an outstanding loan on their whole life policy that they know diminishes their death benefit. The term death benefit is paid in addition to the whole life death benefit on the original contract, thereby allowing the beneficiaries to receive pretty close to what the full face amount of that whole life contract would have been. The term insurance expires after 1 year. The dividend is gone because it went to pay from that term insurance for that year. And then the person might have already paid the loan back and then might choose to allocate their dividends to one of those other 5 ways other than the 1-year term insurance option. 1-year term insurance option, remember, is always used by a policy owner who has an outstanding loan on their original policy that they know if they died during that time, that would reduce the death benefit to a lesser amount equal to the loan plus the interest due on the loan, and the lesser amount would be paid out to their beneficiary. So while they have that loan outstanding, they do not wish that to happen. They wish to use their dividend to allocate it toward a 1-year term policy that can be purchased with a dividend so as to allow the beneficiary to get the lesser amount on the whole life policy, but also the death benefit on the term policy, thereby bringing them pretty close to what they would have received from the whole life policy had the loan not existed on that whole life policy. Next, we're going to talk about insurance contract features, policy provisions. One of them is non-forfeiture options. So when a policy owner, does not want to continue paying the premium, let's say all the way out to age 100 on a straight whole life policy, they would be obligated to pay that premium all the way out to age 100 on a straight whole life policy. But let's say a person gets to an age where they don't want to continue making that premium payment. They have some different options available to them. Their first non-forfeiture option is to just simply surrender the policy back to the insurance company and state that they have no more need for insurance on their life any longer. And the insurance company at that point will surrender the policy, send them a check for the cash surrender value, at which point that creates a taxable event for them in that given tax year. Because when you surrender a cash value life insurance policy and you receive the check for the cash surrender value, you will create a taxable event for yourself. You will be obligated to pay tax on any of the growth inside that contract. You will not have to pay tax on the premium, the cost basis that you have paid into it, but you will have to pay tax on anything that is considered growth. And that's the amount of money in excess of your cost basis. So in this example, this person is a 35-year-old male, takes out a $100,000 death benefit protection, let's say whole life policy to keep our discussion simple, and continues paying that premium over a 30-year period of time until age 65. Then he says to himself, I don't want to continue making this premium payment beyond my retirement year of 65. So what else can I do so I don't have to keep making this premium payment to the insurance company? Well, his first option would be to send the policy back to the insurance company with a request for service form stating he wishes to surrender the policy. They will take the policy, void it out, send him a check for the cash surrender value. And in this example, he would then receive a check for $47,545. Now, any amount of that $47,545 that is in excess of his cost basis, he has to report as reportable income, as ordinary income on his 1044 when he files by the following April 15th. So when he surrenders the policy for cash, the cash value that exceeds the premiums paid into the contract, which are his cost basis, is all considered taxable income for him in that given year. And he has to report it as ordinary income on his 1040 form and pay tax on it. At that point, he has no more insurance on his life at all. A policy is surrendered. It is done. It is over with. The payout has happened to him. He's created a taxable event for himself, and he has to report that as ordinary income on his 1040 form when he files by the following April 15th. Now, if he says to you, the agent, well, I don't want to surrender my policy because I still have a need for some insurance on my life, but I still don't want to keep making the premium payment another 35 years all the way out to age 100 during my retirement. So don't I have any other option? He actually has two other options that he could consider. He could consider having the actuary in home office of the insurance company take his face amount, which is presently a $100,000 whole life policy, where the death benefit is $100,000, and actually calculate out how much the insurance company could reduce down his face amount to make the cash value that's currently accumulated in the policy of $47,545 enough to make that a paid up policy. Then he wouldn't owe any more premium on the contract at all anymore. It would be considered a paid up policy. And if he chose that option, now his death benefit, if he dies, would be reduced down to a lesser amount. In this example, the actuary calculates out that they could reduce it down from $100,000 down to $78,800. So if he chooses this option, the actuary in home office will reduce down the face amount of his policy from $100,000 down to $78,800. Take the cash value from the original policy. That makes it enough to make that a single premium paid whole life policy with a face amount of $78,800. So the first contract goes by the wayside. We take the cash value out of the first contract of $47,545 and we purchase with it a single premium whole life contract now with a face amount of $78,800 And with the amount we have originally placed in it of the $47,545, that is enough to make that a single premium paid up whole life insurance policy. So in the future, he will not owe any more premium payment. And if he sits back and relaxes and allows that cash value inside that contract to continue growing every single year, it will continue to grow on a tax deferred basis until that $47,545 reaches and equals the face amount of $78,800 by his 100th birthday, without him having to pay any additional premium into the contract. So he might do a little bit of calculation and figure out whether or not $78,800 is enough insurance on his life based on his need for insurance. Maybe he still has a mortgage to pay off. Maybe his mortgage is not quite paid off yet at age 65. Maybe he purchased, a new car to go into retirement with, and he still owes some money on that. Maybe he still has some medical expense. Maybe he has still some credit card debt. So he wants to get all of that taken care of and make sure that the amount of insurance on his life would be more than what would be needed to cover all of that outstanding debt yet that he still has. So maybe by the time he adds all that up, he says to you, no, $78,800 is really not enough insurance. I really have a need for something greater than more closely to my original face amount of $100,000. Do I have any other option? He has one last and final option. And the last and final option is that he could allow the insurance company to convert his policy from a $100,000 face whole life policy to the same face amount of a $100,000 term insurance policy. And then take the cash value from the original contract of $47,545, and it is accumulated to become at his age 65, and utilize that cash value to pay the premium on the term policy that is now issued at his attained age for the very same face amount of $100,000. And it would provide him then $100,000 worth of protection for an extended period of time until the cash value runs out. Because we're using the cash value on the original contract to pay the premium on the term policy, he has converted that policy over to. So he will continue to draw from that cash value to pay the premium on the term policy until literally there's no more premium left. There's no more cash value left, at which point there won't be money to pay the premium on the term policy, at which point the term policy will also cease to exist. Now, he says to you at that point, how long would that buy $100,000 worth of death benefit protection on my life? What would be that extended term, that extended period of time that would provide me that $100,000 worth of coverage? And the actuary would calculate that out to be, based on his age, now that he's doing it at age 65, it would provide him $100,000 worth of protection for another 18 years and 36 days. What he has to realize is, in the 37th day, he will have nothing. There will be no more cash value left because all of it was used to pay the premium on the term policy for that 18 years and 36 days. And he will not have any more insurance on his life at all, either from this policy, because the term will cease to exist when we do not pay the premium on it. So that is his last and final option, but at least it gives him an opportunity to continue to have $100,000 worth of protection on his life where he will not have to pay any more premium out of his own pocket, out of his own checkbook. But the premium will come from the cash value he's accumulated on his original contract. So when we convert it from whole life to term, same face amount, he'll still have the same amount of protection on his life. That will not diminish in this case. And we will use the cash value on the original contract to pay the premium on that term policy, or as long as it will pay it. And the actuary calculate that out to be 18 years and 36 days. So what he should do is make sure he has his mortgage paid off in that 18-year period of time. Make sure he has his car payment paid off. Make sure he has his credit card debt and his medical expense debt and any other kind of debt paid off, so he has no more need for insurance. Because in the 37th day, after 18 years and 36 days go by, in the 37th day, this policy will cease to exist. And no more insurance coverage from this policy. Now, he might have other insurance policies in his financial portfolio, but this one will be finished. This one will be over with. So those are known as non-forfeiture policy features. All right, rights of beneficiaries. Now, we will talk about death benefit settlement options, and there are 5 of them. Death benefit payment options available to the beneficiary upon the death of the insured. Most people are very familiar with the first one, receiving that death benefit paid out to them in a lump sum, which is the most common way for a beneficiary to receive a death benefit paid out to them upon the insured's death. They know they're going to receive it federal income tax free. They're not really quite sure what they're going to use the money for. So they just say, go ahead, insurance company, pay it out to me in a lump sum. And then I will receive that lump sum federal income tax free. And I will decide after that what I want to do with the money. Lump sum is the most common way for a beneficiary to receive the death benefit payout on another person's life insurance policy when that insured dies. But there are 4 other ways besides lump sums. And these spell out the word payout, P-A-I-L. Fixed period, the P in period stands for the P in the acronym payout. So, person could choose to have that death benefit paid out to them over a fixed period of time. They could choose to have it paid out to them over a 5-year period of time, over a 10-year period of time, over a 15-year period of time, over a 20-year period of time, even over a 30-year period of time if they want to pay it out to them that long. So they choose a fixed period of time to instruct the insurance company to pay them out the death benefit on the insured's life when the insured died to them as named beneficiary. So if they choose a 20-year payout, then they will calculate what that amount of that check will be, and they will consistently pay it out until all the proceeds are paid out to that named beneficiary over that 20-year period of time. So fixed period, when they choose a fixed period, they are choosing a fixed number of payments over a specific time frame, such as 10 years or 20 years. So here, this example that shows 20-year payout, so it's going to be paid out to them consistently over that 20-year period of time. By the end of that 20th year, all proceeds will have been paid out to them, including accrued interest that proceeds left on account with insurance, how we have accrued over those 20 years. That also will be paid out, but it will not be extending the period of time they have chosen to have it paid out. It will just increase their last few checks that they receive. Another way a person can have the death benefit proceeds paid out to them, well, first of all, fixed period. Person would choose a fixed period when their primary concern is having income coming into their household for a definite period of time. Maybe they're already retired and they want to know that for the next 20 years of their life, they've got this set amount of check coming into their household that they know they can use for retirement purposes. Now, fixed amount, A in the word payout, stands for fixed amount. Here, they have chosen a specific dollar amount they want paid out to them over an indefinite period of time. So they might choose 500, they might choose 1,000, they might choose 1,500, they might choose 2,500, they might choose 3,000, they might choose some other amount. But they're choosing a fixed amount to be paid out to them for an indefinite period of time until all the proceeds are paid out to them. They choose a specific dollar amount for an indefinite period of time. So if they choose, for example, $2,500 per month, then $2,500 will start to be paid to them, and it will consistently be paid every month until all the money is paid out and the fund is exhausted. Even money left on account with the insurance company will continue to earn interest, and that interest that continues to accrue will be paid out to them over an indefinite period of time until all the proceeds plus interest are paid out to them. Now, one thing that is important for you to remember is the proceeds from the death benefit are received federal income tax free, but not interest. Interest is taxable because interest is growth, and growth is always taxable to the recipient in the year in which they receive. So on this account, choosing a $2,500 fixed amount to be paid out to them over a period of years until the fund is exhausted, the amount of the death benefit is going to be received federal income tax free. But any accrued interest that death benefit has accrued while remaining on account with the insurance company, when that finally gets paid out to them, they will pay tax on that because that is considered growth. Person will choose a fixed amount when their primary concern is monthly income and a specific dollar amount they know they need being paid into their household for a period of time, however long that takes that insurance company to pay them out that fixed amount. More flexible than fixed period, since the amount can be altered. So if they start out at 25, they couldn't increase it to 3,000, they could increase it to 3,500. It just will shorten the period of time it is paid out to them. Interest only. Here they are instructing the insurance company to hold on to the proceeds for the death benefit of the policy and pay this person interest only. Pay the beneficiary interest only. So if they hold on to the proceeds, those proceeds will earn interest. And the beneficiary is instructing the interest, I would just pay the interest only. Well, the proceeds of the death benefit are received federal income tax free, but interest is growth, and growth is always taxable to the recipient in the year in which they receive it. So interest only proceeds are left with the insurance company. Only interest is paid to the beneficiary. The beneficiary then has the right to withdraw at any time. Beneficiary receives guaranteed interest rate, and the beneficiary is protected against the claims of its creditors. Any money left on account with the insurance company cannot be attached by that beneficiary's creditors. So the beneficiary is protected against the claims of their creditors. Interest is always taxable because it is considered growth, and growth is always taxable to the recipient in the year in which they receive. The fifth is the life income option, which is L in the word payout. So P in the word payout is fixed period of time a person wants it paid out to them over a certain number of years. A in the word payout is the fixed amount of money they want paid out to them over a certain period of time. I is interest only. Hold on to the proceeds, insurance company, pay me interest only. And the last one is pay out to me over the rest of my life. It's called a life income payout. That's putting them then a single premium immediate annuity that immediately begins payout and will continue to pay out to this person as long as they live. So life income, the proceeds are put into a single premium immediate annuity, and it starts to pay, and it continues to pay income for the life of that beneficiary. As long as that beneficiary stays alive and breathes oxygen, they will continue to receive the paycheck. Okay? That check coming from that single premium immediate annuity. So several payout options from which to choose. A person could choose a straight line payout only over their lifetime. A person could choose to have it paid out over their lifetime, also the lifetime of their spouse. That's called the joint and survivor income option. So there, they would factor in the life expectancy of the first person, the life expectancy of the second person, factor those two life expectancies together, come up with a certain dollar amount, start to pay that certain dollar amount into that couple's household income. And when the first person dies, that same paycheck will still continue to be paid by the immediate annuity into that person's household income until that second one dies. Then when the second one dies, all payout stops. Now, policy riders. Here's where we begin to talk about riders that could be added to a life insurance policy for extra protection at an additional cost. All riders would discuss are things you could add to a life insurance policy for extra protection to provide extra protection at an additional cost. All riders with the exception of one, which is the automatic premium loan rider. We talked about that as an automatic premium loan provision to the contract, but sometimes it's written as an automatic premium loan rider that can be added to the contract. When that rider is added to the contract, it will not cost them more money to add that rider. All other riders will cost them more money, okay? But automatic premium loan rider, if it's written as a rider versus a provision to the contract, that will be the only rider that will not cost the policy owner more money. All these other riders we're about to discuss will cost them more money for adding these riders to their life insurance policy to provide extra protection at an additional cost. So the first one here is waiver premium rider. We can add a waiver premium rider to a life insurance policy. The waiver premium rider will prevent the policy from lapsing if the policy owner were to become disabled and unable to work and earn wages to be able to afford to pay the premium on the life insurance policy. It is not automatic. It must be added at the time of application. All these riders must be added to the policy at time of application. They cannot be added later. So you can assume you will get several test questions on several of these riders on your state exam because they will be testing you and your knowledge of these riders and how they work, because the only time they can be added to a contract is at time of application. They cannot be added later. So you as a selling agent have to have a full-fledged discussion with your client, whether taking out the policy with you, about these additional riders that can add to their contract for additional protection at an additional cost. So waiver premium rider will prevent the policy from lapsing upon the disability of the policy owner. It is not automatic. It must be added at the time of application, as all riders must. and the owner becomes disabled for more than 6 months, it won't kick in right away. There's usually a 6-month waiting period when the waiver premium rider will not pay. But once that person remains disabled for a full 6 months, after that 6-month period of time, now the waiver premium rider will kick in and pay the premium on a policy moving forward so that the policy will not lapse. And the premium is being paid by the waiver of premium rider. So if the owner becomes disabled for more than 6 months, that future premiums are waived until that owner can return to work, can rehabilitate and return to work. And the doctor would have to sign off that they are able to return to work. Premiums paid during the first 6 months provide the policy owner, because they do have to pay the premium and keep it up to date, and they have to pay it out of their own liquid savings account for the first 6 months. But premiums paid by the policy owner during that first 6 months are going to be refunded retroactive back to the day the disability happens once the waiver premium rider kicks in. And the waiver premium rider kicks in after 6 full months that that person has remained disabled. Then the waiver premium rider would kick in and pay the premium forward on the contract and also reimburse the policy owner for the premiums they had to pay themselves out of their own checking account or savings account themselves for the previous 6 months. So premiums or waiver premium rider, premiums are paid during the first 6 months by the policy owner, but they are refunded by the waiver premium rider once it kicks in after 6 full months. Cash values will continue to grow inside the contract and dividends are continue to be paid. Universal Life generally uses what we call a waiver of cost of insurance rider. And the reason we don't call it a waiver of premium rider on UL or VL is because when that thing kicks in on a UL or VL contract, it only kicks in and pays the cost of insurance plus the monthly administrative fee. It does not pay the whole target premium on UL, and it does not pay the whole schedule premium on VL. It gets in and pays only the cost of insurance that is being drafted from the policy account monthly to pay for the death benefit on a UL or VL contract and the administrative charge. That's the only thing that rider will pay. So we do not call it a waiver premium rider because it doesn't pay the whole target premium or the whole schedule premium. It only pays the cost of insurance plus the administrative charge. So on term and whole life, we will call it a waiver premium rider because once it kicks in, it pays the whole entire premium on the term or whole life policy. On a UL contract or a VL contract, we will not call it a waiver premium rider. We will call it a waiver of cost of insurance rider because when that thing kicks in on a UL or VL contract, it will only pay the monthly cost of insurance plus the monthly administrative fee. And that's all it will pay. It will not pay the full target premium. It will not pay the full schedule premium, only the cost of insurance and the administrative fee. So that's why we call it on UL a waiver of cost of insurance rider. Another rider we can add to a life insurance policy is an accidental death benefit rider, an ADTB rider we call it. It provides an additional death benefit if the cause of death is truly accidental, but the person must die within 90 days of the accident happening. If they live too long to day 91, then their death is deemed due to a complication of the accident, not the accident itself, and the accidental death benefit rider will not pay. So the accidental death benefit rider provides an additional death benefit if the cause of death is accidental. Multiple indemnity, for example, 2 times the original face amount, 3 times the original face amount is triple indemnity. Some will even allow you to put quadruple indemnity on your policy. 2 times, 3 times, or 4 times the original face amount. Now, if death occurs within 90 days after an accident happens, and they have this ADP rider on their life insurance policy, then their policy will pay out 2 times, 3 times, or 4 times the face amount of the policy, depending on the rider they have on their contract. The death benefit is referred to always as the principal sum, and it is the least expensive way to have additional insurance issued on your life through the accidental death benefit rider. The reason it is so cheap, so inexpensive, is because most people will die due to sickness or disease, not accident. Some people will truly die of accidental causes. But in the overall scheme of things, there will be many more people that die due to sickness or illness than it ever will be people dying of accidental causes. So that's why it's less expensive. Now, guaranteed insurability right. We call it the GIR right. This enables a policy owner to add the GIR rider on their life insurance policy to guarantee them the ability in the future between the ages of 25 and 40 in 3-year increments, the ability to purchase more substantial amount of insurance on their life based on the amount of the rider they put on their life insurance policy. So if a person takes out a $250,000 whole life policy and adds a $50,000 GIR rider to that policy, they will be paying extra money for the rider, but between the ages of 25 and 40 in 3-year increments, they might have a reason to exercise the rider for the $50,000 worth of additional insurance coverage on their life, and the only thing they have to do is pay the additional premium. They do not have to provide medical insurability to the insurance company to prove they have remained healthy for the rider to be executed. They just have to be willing to pay the additional premium. So the guaranteed insurability rider allows the insured to purchase additional amounts of life insurance at stated ages in the future between their birthdays of 25 and 40 years of age at future dates without needing to take a physical exam or prove medical insurability. Future dates are typically policy anniversary dates after the 25th, 28th, 31st, 34th, 37th, and 40th birthday. There's a 90-day window that opens up that allows the person to exercise their rider for that additional amount of insurance coverage, whatever amount of rider they put on their policy. So in my example, they had a $250,000 policy. They had a $50,000 GIR rider on it. So let's say in age 28, within 90 days of their contract anniversary date, a 90-day window opened up, and they could decide to exercise their rider for an additional $50,000 worth of life insurance coverage on their life just by exercising the rider and paying the additional premium for the additional $50,000 worth of coverage. They do not have to provide medical insurability to the insurance company to prove that they remain a good risk for that insurance company to take on. So what does the GIR rider buy? It buys the policy owner. It guarantees the policy owner the right to purchase an additional amount of insurance on their life equal to the amount of the rider at various stated ages between the ages of 25 and 40 just by exercising the rider for that amount of insurance coverage without having to provide medical insurability to the insurance company to prove that they have remained in good health and are a good risk to the insurance company. So future dates are typically policy anniversary dates between the ages of 25 and 40, and it's limited to a specific age. Beyond age 40, they have a 90-day window. And if they don't exercise the rider within that 90-day window after their 40th birthday, by day 91, the window will close and the rider will drop off the policy, never to be seen again. When the rider drops off the policy because it's never been executed and they've reached their 40th birthday, then their premium cost will be reduced by the amount they have paid for the rider. No policyholder continues to pay premium for a rider that no longer exists on your policy. And this one will drop off by no later than day 91 after the person's 40th birthday. Limited to a specific age of age 40. And additional insurance is based on the attained age, the actual age of the individual when they exercise the rider. Cost of living or cost of living adjustment rider, we sometimes refer to it as a COLA rider. This is going to be in connection with the Consumer Price Index. So anytime you see COL or COLA, cost of living or cost of living adjustment rider, it automatically increases the death benefit based on the Consumer Price Index. And we use the Consumer Price Index to determine how much inflation is increasing at. We are sitting in higher inflationary times now, so we're paying attention to the Consumer Price Index and paying attention to how much interest is rising from year to year. So when you have a cost of living adjustment rider on your policy, that would enable you to increase your death benefit based on the CPI. And we use the CPI to determine inflationary rates. When inflation goes higher, your dollar doesn't purchase as much. So the death benefit, if it's the stationary in a high inflationary times, the death benefit wouldn't provide as much protection to your beneficiary. So some people want to add a cost of living adjustment rider to their life insurance policy when they take out the policy, that the rider would adjust the death benefit based on CPI and based on higher inflationary times. So the cost of living automatically increases the death benefit on the policy based on the Consumer Price Index. Return of premium rider is another rider we can add to a life insurance contract. An increasing term rider is added to a term or a permanent cash value life insurance policy, which increases the death benefit in proportion to the premiums paid into the contract. That's an increasing term rider, which we talked about earlier, that is used on a whole life insurance policy where the increasing term rider increases based on increases in premium payment into the contract. So if you have the return of premium rider in your contract and you die, not only will the death benefit be paid out to your beneficiary, but so will an amount of the term rider equal to the premiums you have paid in for the contract. Another increasing term rider we can add to a whole life contract is what we call a return of cash value rider. Here, the increasing term rider is tied to the cash value increasing inside the contract. So an increasing or return of cash value rider is an increasing term rider added to a permanent whole life policy, which will increase the death benefit equal to the cash value accumulation increase each year. So the only way a person can get the death benefit plus the accumulated cash value in a whole life contract paid out to their beneficiary upon their death is to have a return of cash value rider on that whole life policy, where the increasing rider increases with the amount of cash value increasing every year. So when the insured dies, not only will the death benefit on the whole life policy be paid out, but so will an amount equal to the increasing term rider be paid out, equal to the amount of the cash value that's accumulated inside the contract. So the only way a person on a whole life policy can have the death benefit plus the accumulated cash value paid out to their beneficiary is to have that rider on their contract, a return of cash value rider added to their contract. Now, it will cost them more money to have it on there, but it will assure their beneficiary to get not only the death benefit, but also the accumulated cash value that is accumulated inside that whole life contract. Other additional riders that we can add, an additional cost, a family rider or dependent riders. We call it a family rider when we add one rider on there for all other family members. So many times you're talking to a family unit who wants some insurance protection on every member of the family unit, but they don't have a lot of money to spend. So the cheapest way to insure every member of the family unit is by figuring out who makes the greater amount of income, who brings the greater amount of income into the household. We write whole life insurance on that person's life, and then we would put a family rider on that whole life insurance policy to cover every other family member, the opposite spouse, and all children of the family for one particular face amount. Now, sometimes a person will want a higher amount being provided on the opposite spouse's life and a lesser amount on the children's life. So then we would break it out and say, we will add dependent riders on that whole life insurance policy issued on the major breadwinner's life. We'll put a spousal rider on there to cover the opposite spouse for a certain amount of coverage. And we will put a children's term rider on that very same policy to cover the children for a lesser amount than what the spouse is covered for. So if we want everybody to be covered for the same amount, we could add just one rider to the whole life policy and call that a family rider. Or we could stipulate that we want a spousal rider on that whole life policy issued on the major breadwinner's life for a certain amount for the opposite spouse, and then a different amount for the children that are part of that family unit. So family rider or dependent riders, we use term insurance to add either a child's rider or a spousal rider to a whole life insurance policy issued on the major breadwinner's life. We also may use a family term rider that is one rider added to the whole life insurance policy on the major breadwinner's life. It covers all family members for the same face amount. We could break it out and have separate riders, or we could have just one rider covering everybody else except the major breadwinner for that specific term rider face amount. A payor rider is always used with juvenile insurance. Payor, juvenile insurance. Juvenile insurance, payor rider or payor provision. So payor rider is a rider added to a policy that a parent buys or legal guardian buys for their minor child. Buys for their child. Now, adding a payor rider to that policy is going to be an additional cost, but is one worthy of incurring, because if that parent or legal guardian were to die, or if that parent or legal guardian were to become disabled, then the payor rider that they have put on that contract of insurance on that child's life will now kick in and start to pay the premium forward on the contract, and will continue to pay the premium for as long as that parent or legal guardian remains disabled. And if they die, the payor rider will continue to pay the premium until that child reaches age of 21. Some states it might be, some policies might say 21 or 25. When they're completely out of school, they are an adult and they are responsible for making the premium payment themselves. So a payor rider is always used with juvenile insurance. It's a rider that is added to a policy that a parent buys for a child, and there is an added premium cost when adding this payor rider to the policy. So if the parent or premium payer dies or becomes disabled, the insurance company then waives the premium until that child reaches the age of 21. The premium will be paid by the payor rider. Accelerated benefits rider, ABR, accelerated benefits rider. This is based on a person living, but they have been deemed terminally ill by a doctor or need some serious money to maybe have an operation or a transplant to keep them alive. So accelerated benefits riders really only been in existence since the late 80s, early 90s when AIDS hit in the 80s. Accelerated benefits rider was the insurance industry's answer to a person who contracted a terminal disease where a doctor deems them terminally ill, the death is imminent, it's going to happen probably in the next 2 years, 24 months or less, that gives them the opportunity to turn right back around to their insurance company that they have their policy with and be able to accelerate up to 75% of their death benefit right now while they're yet still alive to pay for medical care costs or to pay for transplants or to pay for medicines that will keep them alive a little bit longer. So it is known as a living benefit or terminal illness rider. Here, if a person puts an accelerated benefits rider on their policy when they take up a policy, and the insured finds themselves being deemed terminally ill by a doctor, the insured has to have a verifiable terminal illness, and they have to be deemed terminally ill by the doctor. Their life expectancy of 12 or 24 months or less is imminent. They may contact their insurance company, and have up to 75% of their death benefit paid out to them now while they're yet still alive in advance of their death to reduce medical costs that they are incurring, cost of medicines, cost of transplants, cost of surgeries, cost of rehabilitation, whatever they're needing, obviously, to stay alive. So accelerating your death benefit while you're alive up to 75% will reduce the death benefit on the policy. You will not be able to access up to greater than 75% of your death benefit while you're alive. And then when you die, the remaining portion will be paid out to your named beneficiary. The remaining 25% of the death benefit would then be paid out to the named beneficiary. So a person may receive a percentage of death benefit in advance while they're yet still alive, up to 75% of the face amount. It will reduce the death benefit by that 75%. And then when they die, the remaining 25% will be paid out to the named beneficiary. They can't access 100% of the death benefit, otherwise the contract would be non-existent. So they can only access up to 75% of the death benefit. Generally, it is not taxable if the person is deemed terminally ill by a doctor. Now, viatical companies, viatical settlement companies, we call them, or viatical settlement providers. Same, 3 different names for the same thing, viaticals. What is a viatical settlement company? A viatical settlement company is a company formed by different investors who pool their investments to form this viatical settlement company. And the viatical settlement company is only interested in buying policies from people who have been deemed terminally ill by a doctor. They know death is imminent. It's going to happen within the next 2 years at the very longest. And so they are willing to negotiate a price to purchase that policy from that terminally ill person who is willing to sell it to the viatical settlement company for that pre-negotiated price because they need money, usually to pay for drugs and cost of medical care to keep them alive and comfortable a little bit longer. So viaticals are viatical settlement companies formed by investors for the sole purpose of buying policies from terminally ill people. So I always tell my students the easiest way to remember viatical settlement companies versus life settlement companies is look at the V in the word viatical. V in the word viatical, let that remind you of the V in the word vulture. Because what does a vulture do? It's this big, ugly bird that sits up in the treetops or up on the mountainside and observes the prey dying and waits for the prey to die before it swoops down and has a good meal. A viatical settlement company acts kind of like a vulture because they're only interested in buying policies from people who have been deemed terminally ill. If a person has been deemed terminally ill, then a viatical settlement company is not interested in buying your policy from you. You would have to seek out a life settlement company to do that, because viatical settlement companies are only interested in purchasing policies from people who have already been deemed terminally ill and will die within a relatively short period of time. So the viator or the viator, depending on how you pronounce that word, the viator or the viator is the original policy owner. So that the O in the word viator reminds you that that is the original policy owner of the contract. That is the person who has been deemed terminally ill by a medical doctor. Okay? So this is the person who now has been deemed terminally ill to know death is coming, it's coming pretty quickly, and now they need money to live off from. So they are willing to seek out a viatical settlement company and negotiate a price with a viatical settlement company now that they're regulated. Prior to regulation, they would only pay approximately 25% of the death benefit base amount of the policy and rip off the terminally ill something awful. But since that time, in the 80s, when they became so prominent because of AIDS, or people were dying of AIDS, and so more and more viatical settlement companies were forming themselves and ripping off the terminally ill by paying only 25% of the face amount. Now that they are regulated by the State Department of Insurance via one whole division of the Department of Financial Services that does nothing but monitor the activities of viatical settlement companies formed in our state, that they are regulated. And because they are regulated, now they have to negotiate a price of somewhere between 50 and 90% of the face amount of the contract. So the policy owner, original policy owner, is known as the viator or the viator. The viatical settlement broker is the viatical settlement broker who negotiates between the two parties, the viator and the viatical settlement company. And the viatical settlement broker must be a licensed life insurance agent, and they can receive no more than 2% of the amount paid to the viator as compensation from that payout. The viatical settlement provider, the VSP, as it is known, is the company that purchases the life insurance policy from the policy owner at a pre-negotiated price, now that they're being regulated, of somewhere between 50 to 90% of the face amount of the policy. The viatical settlement provider purchases the policy from the viator and becomes new owner of it. They make themselves the beneficiary because they're new owner. They make themselves the beneficiary. They are responsible for making the premium payment until that insured dies. They may experience profit then when the insured dies, because they will submit the insurance policy back to the insurance company, and the insurance company will now pay the death benefit to the viatical settlement company. That's where they make their profit. That's where they profit from the transaction. Previous owner receives a lump sum payout, a lump sum buyout of somewhere between 50 to 90% cash. So they sign ownership over to the viatical settlement company, make the viatical settlement company the new owner. They negotiate this price and get the cash out of the contract so they can take the cash and provide for their own means of living. Cost of living, rent, mortgage, food, medical expenses, drugs to stay alive, cost of medical care can be very expensive. So they use the payout from this life insurance policy to use the money for the medical care costs. And the viatical settlement company, the viatical settlement provider, becomes the owner, premium payer, and also the beneficiary of the contract. So fast forward somewhere between when they negotiate this and when the insured dies, which will be somewhere less than 2 years generally, then they submit the death certificate to the insurance company. The insurance company pays the death benefit on the policy out to the viatical settlement company as the beneficiary, and that's where they make their profit. The previous owner normally has a terminally or chronic illness for any viatical settlement company to even think about buying their policy from it. Viatical settlement companies operate like vultures from the aspect that they're only willing to buy policies from people who are terminally ill. And they know death is imminent and it's going to happen pretty quickly sometime in the next 24 months, 2 years. Now, advantages of a viatical settlement company over an accelerated benefits rider on their own life insurance policy is that they could negotiate a larger living benefit. They never used to, but now they do, because the accelerated benefits rider is competition for that. So now they do negotiate a much larger payout than what they were doing prior to regulation of these viatical settlement companies. Before it was 25% of the face amount. Now it's somewhere between 50 to 90% because they know if the person has an accelerated benefits rider on their contract, they can go back to the insurance company and get up to 75% of it. So 75% of the face amount. So it has made competition a little bit more fierce for the medical settlement companies with the accelerated benefits provision rider coming into existence in the insurance world. So medical settlement companies could negotiate a price and provide now a larger living benefit than what the accelerated benefits rider could provide. And it is also free from federal income tax if the person is terminally ill. 24 or fewer months to live per HIPAA of 1997, which stands for Health Insurance Portability and Accountability Act of 1997, is what made these medical settlement payouts federal income tax free to the viator, the person receiving the benefit. Now, upon request, a life insurance company must verify coverage within 30 calendar days. Contract disclosure. They must provide a contract disclosure which includes the following: buyout sum and also terms of the contract. Also, the mode of payment to that individual. Existing rights of the contract. It must outline the benefit, that the benefit may be taxable to the recipient. Also, it must provide a 7-day free look period of time from executing the contract. Also, 2 witnesses need to be present to sign the medical settlement paperwork, and it may affect eligibility for public assistance, such as Medicaid. A medical settlement is effected through the use of an absolute assignment procedure. So they absolutely assign over ownership rights to the medical settlement company. Now, one quick thing before we move on is life settlement companies. I mentioned them. A life settlement company, an example I can give you of them, is a J.G. Wentworth. A life settlement company is just simply a company formed to buy your policy from you because you wish to sell it to them at a pre-negotiated price of something greater than the cash value in it, but something less than the death benefit. And life settlement companies like a J.G. Wentworth is willing to buy your policy from you simply because you wish to sell it, not because you're deemed terminally ill by a doctor. That's why I make the stipulation that the V in biatical, let it remind you the V in the word vulture, because they only want to buy policies from people who are terminally ill. Or life settlement companies are willing to buy a policy from anybody who wants to sell their policy to them, somebody who is in great health, perfect health, not sick, not diseased, not dying, but just simply wants to sell this life insurance policy, which is an asset they own, to a life settlement company at a pre-negotiated price of something greater than the cash value, but something less than the death benefit on the contract. Okay? So that's the difference between biatical settlement companies and life settlement companies. All right. Activity questions. Question number 1. CRAPO, C-R-A-P-P-O, is used. 6-letter acronym used to remember policy owner rights. Is that true or false? That statement is a false statement. CRAPO are the 6 dividend option rights a policy owner has to express to the insurance company how they wish to receive their dividend. Has nothing to do with policy loan rights. Question number 2. The death benefit must be paid to a family member. I could have a friend listed as a beneficiary of my life insurance policy. I could have my business listed as a beneficiary of my policy. I could have my church or my synagogue or a nonprofit that I'm involved with as beneficiary of my policy. It does not have to be paid to a family member. So that is a false statement. Question number 3. The insurance company may not always pay the death benefit. The insurance company may not always pay the death benefit. That is true. Because if that insurance company proves within the first 2 years of that contract that fraud has been created on that application for that life insurance policy, they will void out the contract and they will not pay out the death benefit. The very most they would ever pay is a return of premiums paid to them. So, question number 3 is a true statement. Question number 4, a policyholder may sell their policy back to the insurance company. That is a false statement. You might be able to accelerate up to 75% of your death benefit right now while you are yet still living. That would be you executing the accident or the accelerated death benefit rider that you have on your contract. but you are not going to, as a policyholder, be able to sell your policy back to the insurance company. That is a false statement.